And on today's show, how intra-family funding can benefit the lender and the borrower. Part 4 of this week's series on self-funding indexed universal life for income with premium funding strategist and attorney Robert Strauss. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Robert.
Thank you, Steve.
Day 4, man, if you missed yesterday's show, I thought it was huge. We talked about a case study using corporate funding. Today we're going to talk about intra-family funding in this first scenario, and then going to assets, especially poor performing assets, in the second segment. When we're talking about family, here's a gentleman, Mike Stevens, age 42, medical equipment salesman. He's earning $150,000, my kind of client, and he's earning $1 million, and his net worth is about $1 million. He has no retirement plan. By the way, surprisingly enough, there are so many young men and women that are in the workforce that are pulling down six-figure income and no retirement plan. I can't tell you how many people I see, they haven't gotten to it yet. And they need to catch up. And by the way, that's great, but the catch-up provisions in most 401ks and so forth is still too small to really get up the timeline and catch up. They should have been at this in their early 20s. We're already 20 years late.
Exactly.
So this is a way to play this thing. And he has a budget of $10,000 to maybe $15,000 a year for 10 years. Let's walk through this. This to me is astounding. And this is a millennial play. I think a lot of millennials are saying, I haven't started with my retirement. Here's a way to really get them interested.
This is a very tough fact pattern for your typical financial advisor. I think what most people would probably recommend is a max-funded IUL type of a arrangement like what you see here. His budget is $10,000 to $15,000 a year. Here you can see putting $14,000 a year in for 10 straight years into a $750,000 max-funded IUL policy. Letting that grow, tax deferred. We used a 6.9% assumed crediting rate. And then at age 65, you can see taking out $33,000 a year. That's as much as it will generate. I mean, you know, it's not a bad play. He's put in $140,000 of total investment into this. He's able to take out a total income of $876,000 between age 65 and age 90. And what's left is a death benefit of $217,000 at age 90. Mm-hmm. You know, the after-tax IRR at age 90, about 7%. It's really not a bad deal, but tough for him to retire on $33,000 a year. He's got kids and a wife. Tough for the beneficiaries, you know, if something happens to him, to live on $200,000 of death benefit. So it's not really doing the job, but it's about as good as.
So this is conventional IUL supplemental retirement plan.
Yeah, this is about as good as it gets. This is conventional planning. This is what most insurance agents would probably recommend.
Okay, so we're going to go to mom. Okay,
all right. So we need help, and the help is going to come in the form of leverage. Mm-hmm. But he doesn't qualify for a bank loan. So mom is going to lend him the money, but she wants to do it in a way that doesn't harm her either. Mm. She earns about 3% on her conservative assets. So she wants to continue earning that 3%. So he's going to make an arrangement with her, evidenced by a legitimate arm's length bank note, or I should say a lending note, a loan, where he's going to pay her that 3%. She agrees to help him out. Let's go to the next slide. And she's going to lend him.
This is a true loan. This is not an annual gift.
This is a true loan.
Okay.
And you can't really see it because it's blocked out, but the premium is $118,000 a year for 5 years. That's how much she's actually lending him, $118,000 a year for 5 years. As soon as she lends him that $118,000 a year, he is paying her $14,000 1 day later.
Is that like 3% of that money then?
It's 3% plus principal. So remember, we're prepaying a little bit of principal. That's our amortization schedule. So she's getting paid a little sooner than she would be paid if she were to put that into some other investments. So she's a little happier with when she gets her money. And at the end of that 10-year period, she's getting all of her money back because he's going to take out that policy loan and pay her back. So now mom is paid off at the end of 10 years, but now look what happens to the income. He's still out of pocket the same $140,000 that he would have been out of pocket. But look, his income, instead of being $33,000 a year, is now up to $109,000 a year. He can retire on that, tax-free. Total income $2.8 million instead of $876,000. That's $2 million of tax-free income more. And death benefit has increased to $1.5 million versus $217,000, an additional $1.3 million of tax-free death benefit.
Look at that internal rate of return. The former slide was 7%.
It's gone up.
Now we're almost at 12.
Almost at 12.
And this is a huge, when you start to look at leverage and how it really reacts to internal rate of return.
That's it.
The power of leverage is not small. It's not a small incremental addition. It really pops this number. And so when we're looking at this, this could be a huge strategy. There's two people involved in this is benefiting. The mom's still getting her 3%. She knows she's funding her son's retirement, and this could go a lot farther than just retirement. I mean, you could be doing this for kids, grandkids, education. This could have huge application.
Because there's no bank, he doesn't have to put up any external collateral either.
We come back from the break. We're going to talk about another aspect of this using asset base, especially assets that aren't really yielding that much. We'll be right back after the commercial. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, we're with funding strategist and attorney, Robert Strauss. Robert, we're talking about this time asset base is a whole nother case idea. I'm really looking and trolling, if I'm understanding this theory, some of my low yielding or not that great assets. Hopefully they're liquid, right? And this is what I'm targeting. Walk me through this because I'm really not really loaning to myself right now. Right. I'm targeting assets that I really need to use to make this play.
Yeah, the idea here is really to make your less productive assets work harder for you. That's really the goal here. So, this is going to be attractive, for people that either don't qualify for premium financing or they're so wealthy that they're thinking,
I got my own money.
I got my own money. Why do I have to borrow from a bank? I hear that a lot, actually. Or perhaps the depression baby who, if they have to borrow, they can't afford it, that kind of attitude. So, but there are many, many people who, for whatever reason, don't like borrowing money. So let's go to the next slide.
By the way, I noticed in your slide you call this guy a conservative investor. I'm just like, wow, okay, that was conservative.
Well, and he doesn't have to be conservative. He just needs to have some of his assets that are invested conservatively, because those are the assets that we want to tap into.
Okay.
Okay, so let's assume that we want to use $200,000 a year for 5 years, that we're going to, quote unquote, borrow to put into the life insurance policy and reimburse him. In other words, he's going to take it from his left pocket to his right pocket and put it back into his left pocket 10 years from now. The first thing
this is an opportunity cost play.
It's an opportunity cost play.
It is.
It's literally moving from one pocket to another pocket and putting it back into his other pocket. So we have to first look at what that money would have done had he not used this program. So let's do that first. So if you look at column 3, the $200,000 a year for 5 years is the premium that we would have put into private SFI. And so that's the money that he could invest in his existing investment over here at, let's say, 5% gross, 3% net. And if that continues to grow until, let's say, age 65, that would grow to almost $2 million. And now let's assume that, along with other assets that he has, he's going to use part of that to create retirement income, and he's going to spend that money down such that the principal equals 0 at age 100. That's the rate at which he's going to spend that money down. So if he spends money at that rate, that would create an income stream of $95,000 a year. Now, let's assume that he doesn't live to 100. Therefore, if he lives to age 90, he would have a balance at age 90 in that account left over of $817,000. So let's call that the death benefit. All right, so that's the basis of comparison. Now, what we want to do is take that same amount of money, put it into the policy just for 10 years, give it back to him, let him invest the money that we give back to him. Now we're going to have both the money that we give back to him and the policy, and compare that to this.
Okay, so I have a question. So actually, not only am I putting my original corpus, my original basis back into whatever it came from, whatever low yielding asset or whatever, but now I create a whole new basis over here.
Correct.
Right? I mean, there's a whole new 200,000 basis.
Correct.
That is different than my original money that he fronted into this contract.
Correct. Now he's got both.
I don't want to take time today, but that to me could be a really huge play.
Right. Instead of taking money to buy life insurance and give it up forever, he's just going to put it into life insurance for 10 years and take it back.
But the cool thing about what you said is I still have my 200,000 of basis over in my life contract.
Yes.
I didn't leave repaying it back.
Right.
That to me is the huge part.
Okay.
Oh my gosh.
All righty. Let's go to the next slide then. So now, as you can see, he's got two things working for him. At the end of 10 years, after paying the premiums into the policy, he's going to borrow from the policy and take it back in column 3. So he's got $1 million coming back to him, which he then reinvests into his low-yielding investment. And so that $1 million is going to grow at 5% gross, 3% net until age 65. And if we spend that down so that it's worth 0 at age 100, that throws off an income stream of $75,000 a year. Because he gave up the time value of money for 10 years, it's not yielding $95,000, it's only yielding $75,000. If he dies at age 90, the balance left over is only $645,000 instead of $817,000. So he's given up a little death benefit, he's given up a little income, but it paid the premium, which created another income stream of $217,000 a year.
We've really now created that with both income streams together, right? Is that what this is reflecting over on the other side then?
Yes. So if we go to the next slide, you can add those two income streams together, and you end up with a total income stream of $293,000. And don't forget, because he bought life insurance, it's got its own death benefit, which is another $1.6 million. Add that to the balance that he's got in his side fund and his other investment. And let's go to the next slide, and you can add all of that together and compare it to the status quo. In the status quo, he's got the income of $95,000 a year from age 65 to age 90, which adds up to $2 million. He's got the balance left over of $817,000 for a total of $2.8 million, versus the $75,000 a year from age 65 to age 90, plus the income being thrown off from the life insurance policy of $217,000, plus the death benefit from the life insurance policy of $1.6 million, plus the balance left over in the side fund of $645,000. Total $8.3 million versus $2.8 million.
Huge leverage.
Big leverage, and it's just his own money.
Off not just his own money, his own assets, but we actually targeted liquid assets that were low yielding.
Yes.
See, to me, now we're making it work.
Exactly.
And look at the spread. Overall spread is almost four times the amount.
Exactly.
That's the power. That's really the power of this play. And I remember at the beginning of the week, you said this is where a lot of people are playing. They're not doing actually so much the corporate dollar, the intra-family scenario. This scenario, the asset base, trolling for low yielding assets that are liquid. That's what we're targeting on this.
It's easy to target. I mean, those provide specific needs. Obviously, those are very important solutions, but this is easy to target when you're marketing.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Miss an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.